So that is your US pairs. Now, notably, I think what's on everyone's tongue and the bulk of the posts you see really on TradingView come in line with your S&P 500. Now, I've done this many times, and there isn't there's not as much you can say, because the plan and the bias is practically the same. Okay, the idea is that at this point you've got momentum. Now, lots of people, and we had a really good Academy member, he asked this question specifically. He said, is there any signs of a recession, or can you see signs of the market falling? Now, although we're short biased, it is the case that because of the way I trade, especially, I'm always looking for the best possible deal. And in which case, if you're short up here, that is the best possible short case deal you could get at this current point in time, because it's the highest ever price. Obviously, the higher the price, the bigger the room to the downside. But it's not the case that you can particularly see across the wires that signs of a recession. Now, the reason how you know that is because if that was the case, the market would be falling now. Okay, it would be coming down. People wouldn't be happy to buy if you had news saying that there could be a recession, all of this. So the point of making money trading, or the only way to do it, is to be short, for example, before that happens. Okay, just like you could have been at various points in the past. Normally, the most prolific falls come after the most prolific rises. But that's why I'm short biased here. I don't particularly know when the news is going to come out and say anything bad, if it does for a period of time, but I'm willing to be short before then, because it's very unlikely that this asset can go further than I can handle in terms of hedge gains and controlling my drawdown over time. Now, those are very in-depth subjects, of course, like I said, that we teach underneath here in our trading room. We don't use stop losses generally, we hedge for long-term gains. It's a completely different method, and it's what professionals do. You generally won't see it in public. But it's very relevant on this chart that we're looking at, because not only were we long at this point down here when you came back to your key moving averages, in other words, price had a significant dip within a long-term uptrend, it becomes a very, very good place to buy. You fly up and you get to the upside. And once you've done that, just like you were down here, I mean, when we bought this, it was on negative sentiment, but it was at a key technical price zone. So we know that usually once you fall for a significant period, like you had 3 months here, everyone was saying how horrible the global economy was, how bad it is, and how it could be awful and get worse, right? Everyone was saying that. And that's why we bought, because we know the only time we're going to get a good deal for the long side at this point was when there is negative sentiment. Okay, nobody knows when the sentiment is going to change, but you don't need to make money. That's not a thing, okay? You just have to buy before people buy and sell before they sell. And that's exactly what I am biased doing here, and what my members are doing too. Now, just remember that this is a risky area, because you've had 3 months up and you're above your all-time high. Although you do have significant market value, your closest point of reference for anything is this. There is now no resistance above this. There's no lid, effectively. So it can go as high as it wants, but you've got to be realistic in how far that could extend based on what you've seen previously. Okay, so what I mean is you haven't had a really significant dip beforehand. You only went from 4,600 to 4,100. It's only 500 points. Whereas this rally, where you had it after COVID, you had a drop of 3,386, or let's call it 3,400, 1,200 points, double and more, okay, 150% more than you had. That's why the extension was so far. So it would be surprising, really, if that occurred again. But even if it does, my strategy caters for it, because I can remain solvent longer than the market can push me, essentially. And that's what risk management's all about. Someone messaged me yesterday and said someone said they were $9,000 in loss. Some guy who was on TradingView, he wasn't in the academy. Another guy said he was at 76% drawdown trading this. It's just bizarre. You don't want to go any more than 2% on this asset, probably, or less, 1.5%. You shouldn't be risking your account, because, like I said, there's no reference point for resistance. You don't know when it's going to stop. You know it's a good short trade. You know it's got short side value. You know you should be short, you shouldn't buy, but you don't know the exact point it's going to stop. So how can you risk your whole equity on that one trade? what's the point? I mean, if you did that again, you would lose everything. Ultimately, you would give everything away, even if you were right and it was a home run and it fell straight down from exactly where you said. So the idea is to scale in and scale in lightly. We use the concept mainly of scaling in to basically cast the net out over very long periods with very light sizes, because therefore you've got natural risk management. Okay, diversification with light sizes in a spaced out format is a natural route straight to key risk management. And the idea generally is the same across the board. So, you know, it's as you were really, but even if you're going to add, just space it out as much as you can. Okay. Don't pile in thinking you know when this is going to fall, because nobody does. All right. We just know it's got good short side value. So you've got further extension for your US100 or your NASDAQ. Again, closest reference point is here. So that's going to be your support level when you do fall. I wouldn't be shocked if when you get there, you bounce. And I think that will probably occur when you get something along the wires or the news saying, okay, well, we don't think this is so great. And therefore, you know, we're not too happy with it. Then you'll get people dump their holdings and it will fall significantly. Okay. So that may come at some point. We don't know when it will be, but it will be. Ultimately, that will happen. That is a fact. At some point, this has to fall. Okay. It cannot go up forever. That is basically impossible. You've never had a market that is not manipulated. So I'm not talking about the Zimbabwe dollar, for example, or the Turkish lira. You know, your US100, your NASDAQ, your S&P, every single major index has come down at some point and retraces because people pull their orders out and economies get worse over time as debt grows. That is what called the economic debt cycle. It's an inevitability. It doesn't not happen. It's just an integral part of the process. So that's why we're happy to short, because we know it's never going to go up forever and ever and ever and ever and never come down. Okay, so that's your US indexes.